song for the broken heart.
Good morning, it's Jonathan Barratt with educational grab on trading oil. I think everyone understands that oil is an integral part of any economy. It certainly helps us to grease the wheels of economics, and as it fluctuates, it certainly creates concerns. We've obviously seen a high there of 147, and lately we've seen a low of 67. And I think at the moment it's trading in a band, perhaps at the lower end of the range. But I think today we'll just basically talk about how to become involved in the oil market, and what are the best ways to trade, and perhaps also give you a bit of an insight of what I'm actually thinking, both fundamentally and technically about the price of crude. So let's have a look at the trader and look at a few charts. Now, technically, we've got as good a picture for oil, although our weekly charts haven't turned around yet, but that might happen in the next week or two. But technically, you can see on the weekly chart that we have very good support around these levels. That low there we saw was 67. A breakthrough 67, in my mind, puts a spanner in the works, and we've got to work out what was the cause for that break to the downside, and that would be a fundamental concern, or a shift or a geopolitical situation that will cause that. But as it stands now, the picture looks as if it's trading a range: 67 on the downside, 87 at the top side, and at the lower end of the range, with an area where we're wrong if it breaks, it's at the cheaper end. So if we go from the weekly down to the daily, you can see on the daily chart that it looks as if it's just consolidating. There's the big picture there. Consolidating in a range, that's the lower end, so we'd anticipate it to head back through that US $80 a barrel in the up-and-coming future, maybe the next couple of weeks from here. So quite positive on the outlook there. Obviously a break through that area down there, we're wrong. More importantly, even if we come back to an hourly basis, this is just for trading, you can see that we do have a low here in place. So if you are trading the commodity, whether it be through CFDs, futures or options, we can see that that's the low we talked about on the daily. This is a good area of good support here. This is a breach and pullback. So I would not be surprised to say, well, look, if you were to go long, you can go long at these levels with a stop below 71.50, or you can get on a low through US 70, a stop below 67.50. So they're the two areas just technically of how you could get involved in the crude market, and some of the technical levels when trying to trade it. There are ways to get involved in crude when you do trade it, and what we tend to do is we work from the fundamental picture down to the technical picture. But how do you actually, when do you know when to buy? When do you know when to sell? We use the technical market to help us on those entry points and exit points. A break through this area down 67.50 suggests that our analysis is wrong. So if it breaks through that area, we have to reduce our position. Likewise, a break to the top side through 75 or 76 suggests that our analysis is correct, and then we should be adding on to our positions. At these levels, you can even break it down further. You could buy crude at these levels, or on a break through 74 with a stop below 71.50. So at each stage, you probably already would have picked up that I'm working out a range for my trading platform, from my trading and from my technicals, as to the correct area to get in and to get out of the market. The range from here, 67.50, 76. The range from here, 71.50, 73.20. The big picture as we go out to the daily is 67 on the downside, which we've already said, and the upside is 87. So you can see that we are at the lower end of the range, so therefore it's the cheaper end to actually buy it. So once we've worked out through our fundamental and technical analysis that we feel that a low is in place, then what instrument do we trade? And to me, that's the hard thing, because of the instruments you can trade, there is always attached a certain element of risk. And because crude has been exceptionally volatile over the last couple of months, it's very hard to actually go into a position knowing that you might get stopped out. And that, to me, is the concern. So how do we fix that up when we are trading oil? Well, we can reduce our positions. If we look at the trading platform and we can trade futures, we can trade the front month. So let's have a look at a July contract. Here's the July contract, 73.59, 73.62. The initial margin to hold a position is 5,000 US dollars. One tick, $1 move here is equal to 1,000 US dollars. Now, if you haven't got that risk capital to trade these sorts of markets, then don't trade these futures, because this future perhaps is just too expensive. And I would probably suggest, given that the market has that high volatility, that you have to be prepared to have an initial margin of 5,000 plus an additional $5 or 5,000 in spare collateral to see the trade go. So that's the main contract, but we also have other contracts to actually trade, and they're called the mini contracts. And the mini contracts are actually half the size. And as you can see, when you looked at the price, it's all quite similar. The initial margins are a lot cheaper, 2,500. So therefore, a $1 move in the price of crude is only 500 US dollars. And you might think that for the size of your risk capital that fits in. But in trading the mini, you have to be careful too, because the mini is not as liquid as the major. And that does cause a concern outside normal trading hours when trying to enter and exit the market. So that's something to be concerned about. The other way to trade crude is obviously via options, and options which are quoted. But at the moment on NYMEX, but at the moment with the volatility where it is, you have to be very cautious about the option you buy, because volatility increases the expense, and sometimes it's very hard to get that back even if the market starts to move in your favor. Because with volatility, upwards of 15 to 20%, it makes things very expensive. Crude should be trading around that 12 to 13%, which makes it more reasonable. So if you are looking to trade via the option market, probably suggest the best thing there is to check the volatility. The other way to trade oil is basically through a CFD. CFDs have good points and bad points, but I think if you're just looking for some exposure to the crude market and you don't have a lot of money, then trading the crude market gives you that alternative with very low margins. You don't have to trade a minimum contract of 1,000 or 1,000 barrels or a half at 500. You can actually choose the amount of exposure you want. You might say, I want 50 barrels of crude. The margin's only $300. You might say that I want 250, which is a quarter of a half a mini, and the margin's 1,800. So there are other ways to get exposure to the oil market over futures. And the CFD is one market that you can do that, because you can have an exposure without a great expense and without a great concern that you'll be whipsawed out of the market if anything happens. So when you look at it, it's actually a good instrument to get exposure, but not too much exposure. In fact, we like the CFD side because it allows us to add to positions very quickly. It allows us to take off positions whilst also having a core position. So although you might pay a little bit more in the spread and the interest over the futures, it makes the instruments just perhaps a little bit more, easier to get in and out of. So when trading crude, we've looked at the technical and the fundamental pictures. Choose the product which suits you the best, whether it'll be a major, where a mini, or a CFD, or an option, right? And then once you're involved, just check that technicals in terms of getting the right entry and exit points. And for the educational grad, I hope you had your fun. If you've got any emails, then please feel free to send them to me. It's jb@commoditybroking.com.au. Have a look at our tweets as well. The tweets are important because that's how we stay in touch with a lot of our customers. Also look at our YouTube channel, the Commodity YouTube channel, and also our Facebook. So that's about it. If you've got any immediate questions, 1300 660 734. That's 1300 660 734. Happy trading, and we'll talk to you soon.